Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are going to talk about how credit scores affect your financial life, not in the usual technical or intimidating way, but in a practical, real-world sense that reflects how people actually experience money, decisions, and consequences over time. Most people know that credit scores exist, but very few understand how deeply they influence everyday financial outcomes. Credit scores are often treated like abstract numbers that only matter when applying for a loan. In reality, they quietly shape opportunities, costs, and flexibility long before any formal application is made. A credit score is not a measure of wealth. It is a measure of behavior. It reflects how consistently you manage obligations, how predictable your financial actions are, and how well you align short-term decisions with long-term responsibility. This distinction is important because many people assume that higher income automatically leads to better financial outcomes. In practice, behavior matters far more than earnings. One of the most common misunderstandings is believing that credit scores exist to judge people. They do not. Credit scores exist to reduce uncertainty for lenders. They are tools designed to answer one question: how likely is this person to meet their obligations over time? Everything else is secondary. This explains why two people with similar incomes can experience very different financial lives. One may qualify for lower interest rates, easier approvals, and better terms, while the other faces higher costs and more restrictions. The difference is rarely intelligence or effort. It is usually consistency. Credit scores influence borrowing costs first, but they do not stop there. A lower score does not always prevent access to credit. It often makes credit more expensive. Higher interest rates mean that the same decision costs more over time. This quiet increase in cost is one of the most underestimated ways credit scores affect wealth. Many people focus on whether they are approved, not on what approval costs them. Over years, higher interest payments reduce flexibility, slow progress, and increase stress. This is not because of one bad decision, but because of patterns repeated quietly. Another area where credit scores matter is housing. Renting or buying often involves credit checks. A stronger score can expand options, reduce deposits, and improve negotiating power. A weaker score narrows choices and increases friction. These effects are rarely discussed openly, but they are felt consistently. Credit scores also influence insurance premiums in some regions. This surprises many people. Insurers use credit behavior as a proxy for predictability. The logic is not moral. It is statistical. More predictable behavior is associated with lower risk. Whether this feels fair or not, it affects real costs. Employment can also be indirectly affected. Some roles involve financial responsibility, access to assets, or security concerns. In those cases, credit history may be reviewed. This does not mean a single mistake defines you, but long patterns of instability can raise questions. One of the most important real-world observations is that credit scores do not respond quickly to intention. They respond slowly to behavior. Promising to do better does not move a score. Small, repeated actions do. This delay frustrates people and leads many to give up too early. Another common mistake is believing that credit scores improve through dramatic actions. People close accounts, open new ones, or make large payments hoping for instant results. In reality, credit systems reward boring behavior. On-time payments. Reasonable balances. Stability over time. Late payments are especially damaging, not because of the amount missed, but because of what they signal. A late payment suggests unpredictability. Even small delays can have outsized impact. This is why organization matters more than income in many cases. Another behavior that quietly affects scores is credit utilization. Using too much available credit, even when paying on time, can signal strain. This does not mean credit should never be used. It means usage should feel controlled, not stretched. Many people also misunderstand the role of credit history length. Closing old accounts may feel like cleaning up, but it can reduce the depth of your financial record. Credit systems value time. Long, stable relationships with credit matter. A subtle but important point is that credit scores reflect averages, not moments. A good month does not erase a bad year. A bad month does not erase years of consistency. This long memory is frustrating, but it also means recovery is possible with patience. Another observed pattern is emotional avoidance. People who feel embarrassed or stressed about credit often stop checking statements or scores. This avoidance increases damage. Credit systems punish silence more than mistakes. Awareness restores control. It is also important to understand that credit scores are not static identities. They change. People often label themselves as good or bad with money based on a number. This mindset creates stagnation. Credit behavior can be redesigned with structure and time. From a wealth-building perspective, credit scores matter because they affect leverage. When used responsibly, leverage can accelerate progress. When mispriced, it slows everything down. Better scores mean better leverage terms. However, credit is not a replacement for saving or investing. It is a support system, not a foundation. People who confuse these roles often struggle. Credit works best when it complements stability rather than compensates for instability. One of the healthiest shifts people make is moving from fear of credit scores to understanding them. Fear leads to avoidance. Understanding leads to intentional behavior. The system becomes predictable rather than threatening. Another key insight is that credit scores reward restraint more than ambition. They do not care how aggressively you pursue growth. They care how reliably you manage commitments. This is why slow improvement often outperforms dramatic resets. In real life, people who benefit most from good credit scores rarely think about them daily. They design systems that naturally support good behavior. Automation, reminders, and clear rules reduce mistakes without effort. Over time, credit scores influence how calm your financial life feels. Lower costs, fewer barriers, and more options reduce pressure. This calm supports better decisions elsewhere. Stress compounds just like money does. The goal is not perfection. The goal is predictability. Credit systems reward predictability consistently. When your behavior becomes predictable, your options expand quietly. Ultimately, credit scores affect your financial life not because they define you, but because they influence how systems respond to you. Understanding this removes emotion and replaces it with clarity. When you stop treating credit scores as judgments and start treating them as feedback, improvement becomes practical. Small changes matter. Consistency matters more. If this discussion helped you see credit scores more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.